Rod Alba with the ABA joins us again to talk about the ability to repay and qualified mortgage rule. Lots happening here, so stay with us.
You're listening to the Compliance Insiders with Roger Fendelman, where you can hear the best and brightest experts in the mortgage industry discuss compliance and technology issues that affect you. It's all you need to know in 10 minutes or less.
Rod Alba is Senior Vice President and Senior Counsel for Mortgage Markets at the American Bankers Association. He's been with us several times before and always has great insights. Rod, thanks again for joining us.
Well, I'm very happy to be here, Roger.
Well, you and I have been talking a lot about the ability to repay and qualified mortgage rule. Lots of things happening, and a lot of people are talking about it in 2019. It's turning into one of those big ticket items. You, along with the ABA, have published 10 issues to look out for in 2019, and I think that the rule ranks right up there as number one. So, as we all know, the Bureau just issued last month their assessment that they were required by law under the Dodd-Frank Act to do after 5 years of the ATR and QM rule. And their assessment was very long, and they had a lot to say. But in the end, they really came to some conclusions. And I'd like you to fill in the listeners to what it was that they came up with and your thoughts on that.
You are right. The Bureau just issued a report that does a backwards assessment on the ability to repay rule. This was required by the Dodd-Frank Act. So it is the Bureau fulfilling its duties under the law to do an analysis, an assessment on whether the ability to repay rules are working, what is the impact upon consumers, what is the impact upon the costs to banks and lenders regarding compliance, and any additional elements that may come into assessing the economic impact of this regulation. The assessment was issued on January 10th, and it is only now that discussion is really beginning to come to the fore about what the impacts will be on this assessment and where we're going to be going with the Bureau's activities on ability to repay. The basic finding of the report, Roger, is that the rule really had negligible effects on a borrower's ability to access credit. It also had negligible impact on the cost of mortgages at the aggregate market level. I am looking at a quote in the report now. According to the CFPB, it says that, quote, there was not a significant break in the volume of mortgage applications or average approval rates at the time the rule became effective. So this is a very notable finding of the report, Roger, and I'll explain to you why this may have an impact.
Yeah, please do, because we know that in an alternate universe, they might be right.
That's right. And a very notable element of the report, again, is that they had to measure both impact on consumers and the impact on costs. They are stating that these costs were minimal. The report states that the rule does not appear to have materially increased costs or prices. It observes that since the costs of originating were rising before the rule went into effect, that is when the Dodd-Frank Act came into effect, all the costs in the market were rising. The Bureau says that it cannot conclude that the rule was a cause of the cost or price increases that we may have seen since that time.
Let me stop you there for a minute and I don't want to stop your train of thought at all, but I will just say this, that there is a little bit of truth to that because when the rule went into effect, lending was as tight as can be, lending standards, because we'd already learned our lesson as an industry. So in that sense, yes, in 2012, 13, 14, the underwriting standards were very tight to begin with, but there's no room for expansion. And so I don't want to change what you were getting into, but that's not really answering the question.
Well, that's right. And I think you're right at the point that what they're using as a benchmark is the day before the QM rule went into effect. And they're comparing that to what happened right after the QM rule went into effect. When you consider that the numbers and the originating numbers were probably at their lowest in history when this rule went into effect, and you compare it to the day after, well, then yes, there is no impact. If you look at the fact that underwriting standards were at their tightest the day before the QM rules went into effect, then you can say, surely this rule did not really have an impact on changing those underwriting standards because, well, we had already gone to the most conservative point that the industry had been in years. So I think the conclusion you can reach from that is that the Bureau is not saying that there was no impact. What the Bureau is saying is that you cannot pin a decrease of products in the market, or you cannot pin an increase in cost of originating or on compliance on this rule. Since the costs were increasing at the time, and since underwriting was at its lowest point at the time of comparison, then the injection of this rule into the market did not have a measurable impact on what was already occurring.
Now, before I went to law school, I was an economics major. And the one thing that I took away from 4 years was the notion of opportunity cost, which is the foregone alternative. And that theory plays a huge role here because the opportunity cost of the ATR QM rule is the loss of additional lending to otherwise qualified consumers who are effectively locked out of the real estate market because they can't get a loan.
You said it, and that's exactly the opinion, certainly my opinion and the opinion of the American Bankers Association. Let's assume that today we are selling 100 plates of spaghetti, lasagna, and ravioli, just to make this into an Italian meal comparison. What the Bureau is saying is that the advent of this law, what would happen after is if we would continue to sell 100 plates of only spaghetti, that there's no impact. In other words, the amount of loans perhaps didn't change, but the makeup of the loans certainly did. And since we are selecting a point in history at which we are at the lowest in terms of underwriting, we cannot measure into what happened right after the law, which is a continued sort of low level of originating that has only started to increase thereafter. We think that that is a mistake. We at the American Bankers Association have expressed our very strong views. The ABA differs from the assessment results. We do not believe that this is a credible assessment of the rule's impacts on costs, compliance burdens, and the elevated risks, Roger, that are being set forth by the rule. We differ significantly as we look at our American Banker Association member surveys from the past. The report does perhaps make several notations that in certain qualitative surveys of mortgage lenders, a majority of mortgage lenders indicated that they had changed their business models as a result of the rule. Well, that one sentence lost in the middle of the report says everything, Roger. I mean, if everyone had to change their business models, if we had to change our product mix, if we had to change the way we assess risk, then something is wrong with the conclusion that this rule had absolutely no impact upon either costs or originating levels.
Yeah, and I would say that there are 3 or 4 or 5 items keep rising to the forefront when we talk about, well, what did originators and investors do that's different? Front and center, they capped DTI at 43%. Now, of course, the GSE patch, which allows the GSEs to go beyond that, which is very flexible, is a much better approach. But that's an issue for everybody else. Then good old Appendix Q, which is a nationalized underwriting standard, which in theory is a great idea because people have been asking for certainty and clarity. However, it's not completely clear and it can be a little bit restrictive. Again, look at the GSE patch for more guidance on that. Then another issue, and there are many others we know, but another issue is the safe harbor QM because it hasn't been litigated yet. So few of them have gone into foreclosure where the consumer has raised improper underwriting and a failure to take into account their ability to repay when the loan was originally underwritten as a defense to foreclosure. And so since it hasn't been litigated, nobody knows what happens to it. In my opinion, I think most, if not all loans that are being originated today, regardless of whether they're safe harbor QM, rebuttable presumption QM, or not QM at all, they are really well underwritten loans. And I think consumers may be somewhat hard pressed to challenge the underwriting on those loans in the unlikely event of foreclosure. But Wall Street doesn't look at it like Roger does. And I think they're very skittish after the last decade or so and just don't want to get involved until there's some certainty.
You're absolutely right. And I will repeat nothing of what you've just said because I think you've described what's happening. I think that it's probably best to take that statement and then analyze it in accordance to what the Bureau says next, Roger, which is that the report very clearly goes on to state that the GSE QM that you just mentioned is prominent. In other words, there's a QM patch that was injected into the ATR QM rule that basically says that anything that meets the Fannie or Freddie standards will satisfy the QM conditions for a safe harbor. a crucial element that is raised by the report is that the GSEQM still sustains a majority of residential lending in the United States of America.
Right.
The CFPB describes this as a shortcoming of the regulatory structure. The report confirms, if you will, that what is the central issue that has been identified, certainly by the American Bankers Association, but also by many other segments that are critiquing the law, that is the need to resolve the status of this temporary GSEQM. Please understand that this GSEQM that the Bureau calls dominant is going to lapse in 2021 or when the GSEs leave conservatorship. That is an extremely important point because should there be a lapse of this GSE temporary QM, there will be a massive market disruption.
Incredibly massive. Again, it's an untested part of the rule in court, and everybody knows about margin compression today, and I don't think there's any changes on the horizon regarding that. So I don't know if lending is really going to pick up in a significant way over the next year or two. So if margins are already tight, lending is down. Many originators are suffering today. They don't have the volumes they had before, and the GSE patch disappears in less than 2 years. I think that's going to be a catastrophe.
That's exactly right. It's a catastrophe for existing production that currently relies on the GSEQM. And let me also say that it's a catastrophe for consumers generally. The report did find that there is, and please understand the full import of what I'm going to tell you. The report finds that there is no noticeable innovation outside of the GSEQM segment. The Bureau is saying that the only real credit expansion that the market is seeing is when the GSEs change their credit standards, therefore enlarging the GSEQM patch.
Yeah, no
So the report, in short, sets forth, perhaps admits that the GSEs have expanded underwriting beyond what the ATR law articulates. The GSEs are expanding the limits of the law itself. The report also makes another crucial finding. It reports that the GSEs have expanded underwriting beyond what the ATR law articulates, Roger, with 21% of loans being made above the ATR defined limits. What this is saying is that the GSEs are setting their own standards, going above and beyond what is allowed under the ATR rules, and yet that is being accepted as being QM because of the special privileges provided by this QM patch. That has to be resolved, and that's going to be a central issue that the entire industry is going to focus on going forward.
So, what happens next? Industry pundits have been chiming in on what the Bureau is going to do and whether the GSE patch disappears and the Bureau is going to be steadfast and not really making any wholesale changes to ATR QM. I want to hear from you. What's your take on it?
I've read the same articles, and I guess we've seen the same interviews about the fact that the finding of no impact by the Bureau does not really bode well for any significant regulatory reforms going forward. We disagree for various reasons. Again, please understand, the Bureau did not say that there is no impact. What the Bureau said is that they cannot pin any impact upon this rule. That's a crucial difference. So that's number one. I think that with some proper educating and some demonstration through economic studies and other numbers, we have been communicating with the Bureau and telling them that, there may be very wide and serious impact that you may have missed. That's number one. Number two is the mere fact that this GSEQM is going to lapse. If we leave things alone, if we don't engage in any rulemaking in 2021, the GSEQM lapses. And as mentioned, we will have a serious market impact without that crucial bridge over to the new world. This is, again, what the Bureau has identified as a major element of the report, which tells me and assures me that they will be heading into rulemaking. The other element where we can understand that they're going into rulemaking is that the Bureau, the staff and the leadership is itself saying that they will be heading into a reopening of the rule in 2019. This does not mean that we will have a new rule by the end of 2019, but we certainly expect that there will be a broad proposal that will be put out by the Bureau by the end of this year. And that proposal is certainly going to address the lapse of the GSEQM, perhaps liability issues under the ability to repay rule, as well as perhaps the safety or the propriety of making non-QM loans. It's going to be a holistic approach at reviewing the regulation. And again, we expect that some proposal of this type will be issued by the end of 2019.
Rod, that's welcome news. And looking back over the last 10 years, we know that this could end up being a mixture of things that are good and things that are not so good, and a lot of compromises between industry and government. There are many requested changes to the ATR QM rule proposed by the industry over the last several years. I think MBA, for example, had a list of 8 or 10 or maybe even 12 items that they wanted the Bureau to review. And I wouldn't be surprised if everybody had collaborated, including the ABA, on that. I would say, based on history, they may not give us everything. So knowing that, we have to be careful about which items we bring to the forefront and really ask for change on. And I think that's going to be an issue. It always is. So it's welcome news that they're going to be looking at this and making some wholesale changes. But the ultimate question is, what will the Bureau's take on that be? What will be their focus? And will they go far enough to open up the mortgage origination market enough to increase lending to creditworthy borrowers, continuing to maintain safe and sound underwriting practices, and do something to alleviate the potential for risk in litigation?
Roger, I think that's absolutely right. I will tell you that the industry is very well aligned in seeking changes, in seeking that the Bureau inject a little bit more oxygen into the rules so that we can make loans to a broader segment of our communities. I think that those proposals are on the table. They are well thought out. They have been discussed among industry players. So those proposals are on the table. And you're right, there is a summary and analysis of those items in the appendices to this report. And I think that your listeners would be well informed to read them over. I will also give you another element that we as professionals have to think about regarding the structure of this rule going forward. Currently, what we have is a rule that defines what is the ability to repay and then sets forth all of these safe harbors, if you will, that apply in a limited manner. So you may have the broad GSE QM, you have a regular QM, you have another QM for small lenders, you have a special QM for FHA lending, you have some other QMs for balloon notes. So you have this collection of different safe harbors that are structured within the law. So one approach is, do we take all of these various QMs and perhaps add more, or maybe take those various QMs and expand them a little bit so that we can make more lending under those QM patches that currently exist? The other approach, of course, is to take one QM, one broad standard, if you will, kill everything else, but keep a QM that will make sense in terms of laying out the principles of lending for all types of lending. Make it simple as an underwriting structure, make it simple as a compliance structure, but keep only one and rid the law of all of the other sort of pesky little QMs that exist under the big rules. That dichotomy, that discussion about what approach we take is going to be one of the major discussions on the table.
Right.
And I think that we both as legal professionals, compliance professionals, and lenders and practitioners in this industry, we have to look at those differences, the various approaches make vis-a-vis consumers, and how it is that we can best safely expand lending under this law. It's going to be a fascinating discussion going forward.
It really will. It's a tough issue to answer, and everybody's going to have a different one, of course. And that's only one of many, because then we look at, what about 43 DTI? Does it have to be that way so that if you have a loan and you think the DTI is exactly 42.9%, but maybe the calculation through good faith error was actually 43% or 43.01%? No safe harbor there. You've got a non-QM loan that's potentially actionable in the event of borrower default and foreclosure. Is that right? Is it really that much of a difference? I think the borrower was just as well qualified at 42.9 as they were at 43.1. One of about a dozen things we have to take a look at and find really positive ways to address and solve so that we can kickstart lending.
And I would opine that the liability provisions, how you assess liability upon the industry, how you cure these mistakes, how you may be able to correct certain elements where the consumer is not affected, those things need to be reviewed and actually solidified under the ability to repay rule. So that's going to be an important task in this upcoming regulatory review in 2019.
Indeed. Rod, this was a great conversation. Let's stay on top of it. I know you are at the ABA, so let's have another conversation again soon, talk about this a little bit more and see what new developments are happening. And we'll definitely be regrouping as soon as the Bureau starts putting together a new proposal.
I would be happy to do that, and I look forward to the conversations.
Are you a compliance insider? Then go to compliancepodcast.com immediately and join our mailing list so you never miss an episode. Got something to say? Request to be on the show. Go to compliancepodcast.com with your topic ideas. And as always, thank you for listening.